If you want to make consistent money trading in the markets, you don't need to learn 100 different indicators or complicated systems. You just need to master the raw price action happening right in front of you. Welcome back to the Alpha Network. In this video, I'm going to show you two of the most reliable, high probability candlestick setups that professional traders use every single day to catch massive market moves. We are talking about the hammer and the shooting star. These two specific shapes give you an immediate, crystal clear signal of exactly when the trend is about to reverse, allowing you to get into highly profitable trades at the absolute bottom or the absolute top. Firstly, we're going to break down the basic components of a candlestick so you know exactly how to read them from scratch. Then, I'll show you step by step of how these three ultimate patterns form, why they're so incredibly powerful, and exactly how you can trade them to grow your entire account. Let's dive into these components first. Before we look at the setups, you need to understand the basic anatomy of a candlestick. Every single candle chart is made up of two simple parts, the body and the wicks. The wicks are also known as shadows. So the body is the thick solid rectangle in the middle. It shows you the distance between the open price and the close price. During that time frame, if the price goes closer higher than it opened, it points green, meaning that the buyers won. If it closes lower than it opened, it prints red, meaning that the sellers won. The wicks. These are the thin lines sticking out at the top, as you can see right here, and the bottom as well. They show the absolute extremes of the session, the highest point the market reached, and the lowest point it touched before the time ran out. So now I'll delve into how the candlesticks actually work. So, as you can see in the bullish candlestick, the highest point is at the top of the wick, while the lowest point is at the bottom of the wick. So, this essentially means the lowest price it reached at the end in the entire session and the highest point it reached. And the closing price is the price at which the market closed at, while the opening price is which the candlestick opened at. Same for the bearish. The lowest point is at the bottom, which essentially means the lowest point the candlestick was during the entire session, and the highest point is the highest point it was at. And similarly, same for the opening price and the closing price. The biggest mistakes that beginners usually make is guessing what a hammer or a shooting star candlestick looks like. This is often based on its appearance, but if you guess, you lose money. Professionals use an exact mathematical rule, the 0.382 Fibonacci threshold. To confirm a valid reversal, map the Fibonacci tool from the absolute high to the absolute low of a single candle. The real body of that candle must sit entirely outside the 0.382 boundary. If the body leaks past that 38.2% mathematical line, the rejection is too weak, momentum is split, and you should not take the trade. Firstly, if you look at the hammer setups on the left, the color of the body doesn't essentially matter, the math does. Sellers push the price down hard during the sessions, but buyers slam it right back up before the close. For this to be a valid buy signal, that lower wick rejection must force the real body to lose completely within the top 38.2 percentile of the candle's total height. This mathematically proves that the buyers completely crushed the sellers and took back over 61.8% of the session's territory, ultimately meaning that the candle should result in a very high chance of profit. Now, if you look at the shooting star candlestick on the list, buyers pump up the price to make a new high, tapping retail FOMO traders at the top. Then institutional sellers step in and dump the price back to the baseline to confirm the sell signal. The upper wick rejection must force the candle body to close completely inside the bottom 38.2 zone of the total range. This proves the bears took back over 61.8% of the market. Now, this shouldn't be overcomplicated, so I'm going to show you an actual demonstration in an actual market like setup for Nifty 50. This is the Nifty 50 index, and right here, as you can see, there might be a hammer candle. So I'm going to use the Fibonacci threshold tool to confirm that. So if you take the measurement from the top of the wick to the absolute bottom, you can see that the 38.2% threshold lies right below the actual body, which means that the stock has extremely high chance to increase, which can be seen further upon, where it significantly increases the value. Next up, we have the shooting star candle. So, firstly, if you look at this pattern right here, you can clearly see that the candlesticks constantly go in an increasing movement, which ultimately means that this is the vertex if you analyze the entire chart. And there is an extremely high chance of decline right here because there is a shooting star candlestick pattern, but we do not know that yet, so we need to make sure. So if we use the Fibonacci tool and go from the bottom to the top of this, you can see that the 0.382 threshold lies right outside of the body. This essentially should mean that the price of the candle is going to decline, which means if you were short selling, you will make significant profit. The exact same trajectory follows right here, where the price significantly declines from an opening price of 23.748 and a closing price of almost 23.167. So you essentially made a very high amount of profit if you were short selling. That's it. Seriously. Those two things are all you need to completely transform your entire chart analysis. Don't complicate it with 20 or 50 different indicators or massive chart sheets, as the truth is, most of these aren't even effective. Master the math behind the hammer and the shooting star, stick to the 0.382 boundary rule, and manage your risk. It's honestly that simple. Thank you so much for watching this video. Make sure to like and subscribe because there's going to be a new video coming every single week. Bye.